Good day, fellow investors. Buybacks haven't done any good over the last 7 years. We discussed here how we might be in a lost decade ahead, and Glenn said how, yes, that was the case in the past, but you didn't calculate buybacks that always push stocks higher and will keep doing that for the next decade and two. Now, I will argue that buybacks don't help that much, and those depend on price paid, of course. Plus, even Mark Cuban said something about the taxes. We'll touch on that, but he said that buybacks are everything wrong with what companies do. And my take, you will see, is that buybacks depend on price, and that factor impacted that buyback activity, huge buyback activity over the last 7 years, has brought zero value. Let's start discussing, but before, if you enjoy this type of content, smash that like button and consider subscribing if you want more rational analysis for your investment decisions. Let's start with the buybacks mantra over the last decade. If we look at the amounts of buybacks, this is quarterly for the S&P 500, you can see that in the bull market of the 2000s, buybacks just increase. Similarly, now increasing, and this is the big jump here from the Trump corporate tax lowering. And companies have this idea that the more buybacks they do, the better it is for shareholders, more tax effective than dividends. If they have free money, even they take debt to do buybacks. So everybody happy, right? Well, absolutely wrong. As Mark Cuban said, buybacks are everything wrong when it comes to stocks today. So let's look a little bit more in detail. This is a great chart comparing dividends and buybacks. And the first thing that hits my mind is the stability of dividends versus the insanity of buybacks. So that's something very, very important to understand. And the higher stock prices are, the higher are the buyback levels, which is again totally irrational and opposite of what investors should do. And if we look at the quarterly buybacks as percent of market value, we can see that over the last 10 years, actually, the quarterly percent, the buyback yield actually on average goes down because prices go up, which means that those buybacks are less and less effective. This is pure stupidity, but as prices are higher, like those were in Q1 2022, 374 companies reported buybacks at the peak of the market, up from 335 when stocks were lower. So buying high, selling low, not a great way to make money and investment returns. And that's exactly what Mark Cuban discusses in another interview that I found in this tweet. Buybacks are a response to the pressure from big investors to C-suite who want to engineer earnings per share to try to goose the stock to hit bonuses for managers. He continues in the CNBC interview, I think companies have to make decisions, public companies in particular have to make decisions between tax buybacks and share buybacks rather, and dividends. A lot of companies seem to believe the old notion that share buybacks were more tax advantage for shareholders. That is just not the case any longer. And the reality is for share buybacks, you reward the people who are leaving and selling your stock instead of rewarding the people who are keeping your stock. This is very important to understand in this situation now with the stock market, and we'll dig deeper into the mechanics of this. If you look at buybacks, this is the issuance of stocks, and you can see that over the last 5 years, on average, let's say companies have spent something around 500 billion trailing for buybacks. However, if I compare the 500 billion buyback real and what they actually spent, then I see that the average is 800 billion. This is perhaps mostly 400 billion trailing 12 months, and the reality spent should be around 800 billion. This simply means that the buyback yield, the real buyback yield, is not 2.4% as it looks what they spent, by maybe half of it, because they issue shares as soon as there is a hiccup. They issue new shares, which is counter to the buyback. So they buy back stocks high, and when prices are lower, they issue shares, and that is simply stupidity squared. And then you are incentivized to sell the stock, not to own it. When prices are high, sell to the company and let the other shareholders be the big holders. My issue is, of course, we have said buying high and selling low. The higher stock prices are 2007, 2018, 19, and here the peak of 2021, 2022, and now already that stocks are 25% lower, buybacks are also 25% lower. Further, if you look at the number of companies doing buybacks, you can see here how the mania started, dot-com bubble, but look at how the number declines, then it goes higher, again, highest number at the peak, then lower, and just going higher and higher. And the second problem with buybacks is that it assumes that businesses will continue forever being there, forever growing, forever printing money, which is simply not the case for most businesses out there. Just think of Delta Airlines. They did huge buybacks here, and then their business model without the bailouts was destroyed. The government saved the shareholders. They shouldn't have done that, just give it to the bondholders, but they did it, and still the business is not doing well. That's just one example, but let me give you a 20-year example. Top S&P 500 components for 2000. General Electric is gone. ExxonMobil didn't do much in the last 20 years. Pfizer is lower, just saved now by the boosters. Citigroup is gone. Cisco lost so much. This did okay likely, this did okay, but still when market cap not that much. This is gone, this is lower, this is at 50% of the market cap then. So just one company, two companies out of 10 made it through 20 years and are actually better. So when you look at buybacks and you look at this, it's insanity that every company does buybacks. That's how it is. And doing buybacks when everything is great is actually counterproductive. The reality is things change and buybacks destroy value. The problem is that management is paid to say things will never change, and actually they have to think like that. On the tax, buybacks of 1 billion, 1% is 10 billion. That's nothing relevant now. It will become relevant if that tax goes to 10%. Then it is, let's say, balanced maybe with dividends, and then it is another ballgame. But until then, nothing to mention there. Now, when it comes to my rule, if I am buying the stock and they are doing buybacks, then it's great. Then I'm happy about the valuation, business outlook, and everything. So that's my rule for buybacks, very simple. The problem is that that is very rarely the case, but then again, the companies and everybody does buybacks because, Sven, buybacks have outperformed everything else. Not that fast, my friend. If we look at buybacks, if we look at, this is the start, 2002, no difference here, and then you can see here the discrepancy of S&P 500 companies with buybacks destroying the S&P 500 index. If you look at here, 2 times 25 better are the S&P 500 buyback index versus the S&P 500 index. But since 2015, if we compare those two, the discrepancy is now down to 1.65. So the index did beat the buyback index from 215 to 220, and also from 215 to 222, because the difference there, the discrepancy, hasn't been the same. And if I put this into a different perspective, look at the buyback index performance. When did the discrepancy happen? That discrepancy happened when there were low prices, 2009. This is again, discrepancy in performance happened in 2002 and 2001 when there were low prices. 2013, the European crisis, global crisis, low prices make buybacks an advantage, of course, for the companies that do those buybacks. So, guess what? When prices are low, buybacks are smart. When prices are high, buybacks are not smart. So, eventually, even with buybacks, price matters. The essence of value investing, my friends. So, if you want to learn more about value investing, subscribe and smash that notification bell. And then there is another topic, debt. Also, debt matters. And companies have increased debt almost 50% over the last 5 years to do more and more buybacks. So, the actual effect is zero, plus you have that debt that will be detrimental down the road. So this is the story now of buybacks. I hope I explained the situation. Of course, then it depends on the individual company, but on aggregate, buybacks are not value adding to index fund investors, to market investors. So you really have to understand this situation with the specific business, and we'll always look at that from a business perspective when we make our bottom-up business analysis. Smash that like button, subscribe, and I'll see you in the next video.